All right, let's dive right in. Today, we're unpacking a whole stack of sources, articles, research notes, and they're all pointing towards this recent, surge in market volatility.
That's right. And it really seems like these big geopolitical shifts are, the main driver right now.
So our mission here in this deep dive is to sort of pull out the really essential insights from all this material.
Exactly. The nuggets you need to understand what's actually moving the markets. And maybe more importantly, how some investors are seeing this differently.
Differently how?
Seeing potential opportunity in the chaos, actually. Taking a distinctly contrarian view.
Okay, interesting. So it's not just background noise then. There was a very specific trigger the sources highlighted recently. What kicked things off?
Well, the material points pretty directly to the recent escalation in the Middle East.
Ah, right.
Yeah, the reports of Israeli strikes in Iran, and then the subsequent Iranian missile retaliation. That kind of event, it immediately raises anxieties in global markets.
And where did those anxieties show up most clearly first? Energy.
On the energy front, absolutely. The big fear, and this is outlined clearly in the sources, is potential disruption.
The shipping lanes, right? Like Hormuz.
Exactly. The Strait of Hormuz specifically. And you saw an immediate reaction there in oil prices.
You certainly did. The sources showed West Texas Intermediate, WTI crude, spiking pretty dramatically. What was it, like 9-10% intraday at one point?
Yeah, huge intraday swing. It's settled near, 73-74 tutters a barrel?
Which, as the material noted, is actually the highest we've seen since early this year, back in February or January.
Right, and what was really fascinating, and this jumped out from the notes, was the specific trader activity after that spike.
Oh yeah, what were they doing?
There was this significant rush into WTI call options, basically bets on the price going even higher.
Okay.
The sources highlighted traders just flooding into the August $80 calls, over 33,000 contracts traded.
Wow, August $80 calls.
Yeah, and that volume, it was double what we saw back in January. So it shows some real conviction that, higher prices might be ahead.
Okay, so oil is the immediate flashpoint. But these kinds of geopolitical tremors, they always send ripples, don't they, across the broader market?
Oh, absolutely. The materials showed a general market pullback in response. S&P 500 futures dropped around 1.1%. And on one specific Friday, mentioned in the notes, major U.S. stock indices, they saw declines over 1%. Fear prompts a reassessment of risk,
When risk is off like that, investors start looking for somewhere safe to hide. You see that classic flight to safety response.
Precisely. Safe haven assets rallied. The sources pointed to gold jumping, 1.5%?
Yeah, gold up.
And appreciation in U.S. Treasury is always seen as, one of the safest assets globally.
Right.
And even the Swiss franc, often that kind of refuge currency, saw gains. Capital was clearly looking for shelter from the volatility.
Okay, shifting gears just a little bit. The sources also kind of wove in the latest domestic economic picture, specifically around the labor market.
Right.
What did that data show?
Well, the recent labor data discussed in the material, it suggests a potential softening, maybe some cooling.
How so?
Weekly jobless claims, they ticked up to 248,000. The 4-week average held around 240K. But importantly, the household survey component showed a pretty sharp decline.
Oh.
So you take those figures collectively, and they do point towards maybe some cooling in employment conditions.
Now, traditionally, you'd think, okay, a cooling labor market, maybe that gives the Federal Reserve a bit more room, to think about cutting interest rates sooner.
Right, that would be the typical read.
But the sources explain why the Fed is still, pretty cautious.
And that's the real complexity here. Because despite those signs of labor maybe easing a bit, the material really emphasizes that inflationary pressures, they haven't just vanished.
Still lingering.
Exactly. Factors like, tariffs that are still around, and crucially, that energy price situation we just talked about, those are keeping inflation concerns very much alive for the Fed.
So this really puts the Fed in a tricky spot. You've got a slightly softer labor market maybe on one hand.
Right.
But these persistent inflation risks, especially from energy on the other, it keeps them
hesitant.
Yeah. Hesitant to pivot towards rate cuts right now.
Exactly. And this creates a bit of tension with what the market is expecting or pricing in.
Okay, what are the markets thinking?
Well, the sources noted that markets are currently pricing in roughly, say, 70% odds of a 25 basis point rate cut. That's 0.25% by September.
So pricing it in fairly soon.
They are, but the material highlights that the underlying conditions, especially that inflation picture and the geopolitical risk overlay, make that path maybe less straightforward than the market pricing might suggest right now.
Okay, right. Let's try and pull all these different threads together then. We've got geopolitical sparks driving oil prices up, which could reignite inflation worries. A labor market that's cooling, but maybe not collapsing.
Right.
And a Fed that's still sounding very cautious on rates. What's the overall picture the sources paint for the market and sort of the policy implications?
It really paints a picture of significant complexity and how interconnected everything is. The material emphasizes that a sustained rise in oil prices, if it's fueled by this geopolitical risk, poses a direct threat
to inflation staying higher for longer.
Exactly, extending those inflationary pressures. And that directly complicates the Fed's calculations, their ability to even consider cutting rates anytime soon.
And the sources also mentioned, didn't they, that any relief we might have expected from, say, strong domestic oil production or tapping the strategic petroleum reserve, that might not be enough this time.
Right. The thinking is those buffers might not fully counter these global disruptions if they really persist. They're more temporary fixes.
And this has real effects for you, the listener, right? Like at the gas pump.
Absolutely. Rising fuel costs, for instance, could potentially shave maybe 20 cents off U.S. gas prices between now and Labor Day. That's according to analysis in the sources.
Ouch.
Yeah. And that kind of pressure at the pump, it can filter through, it can impact consumer sentiment, maybe lead to people pulling back on discretionary spending.
Which naturally makes you think about which parts of the market might, win or lose in this kind of environment.
For sure. And the sources identified some potential winners, sectors often seen as defensive, or those that benefit directly from these trends.
Like utilities.
Utility sectors, yeah, typically stable. Energy companies obviously are poised to gain from higher prices. And defense contractors.
Right, makes sense. Companies like RTX, Northrop Grumman.
They were specifically mentioned, as potential beneficiaries from increased volatility and maybe concerns around defense spending.
And on the flip side, who gets pressured?
Well, industries sensitive to high fuel costs and potential consumer spending pullbacks. Airlines are a key example. They could face continued pressure.
Okay, so that's kind of the view driven by the immediate news, the headlines, and, that understandable fear response.
Right, the conventional reaction.
But the sources also introduced this really fascinating counter-narrative, a contrarian perspective that looks at this whole moment through a completely different lens.
Yeah, and this is where it gets really interesting, I think.
Okay.
Because while the conventional wisdom might be, okay, fear, uncertainty, sell.
Right, get out.
The contrarian view presented in these sources sees this period not just as risk, but actually as potential opportunity.
Opportunity in this volatility.
Yeah, it's about stepping back, looking past the immediate fear, and trying to spot perceived mispricings in the market.
Okay. And the sources actually detail several specific contrarian takes, starting with oil itself.
Exactly. So on oil, the view here is that it isn't just reacting, it's potentially on the verge of a genuine breakout.
A breakout higher.
Potentially, yes. That high level of speculative positioning we talked about earlier, the $80 calls. From this view, that could actually fuel further momentum, pushing prices not just into the $80, but maybe towards or even above $100 a barrel if the conflict were to escalate further.
Wow, $100 plus ball.
It's a possibility they raise. So from this perspective, smart capital isn't avoiding oil, it's actually flowing into long oil positions.
Betting on higher prices.
Right, through futures, inflation hedges, and even specific companies, energy companies sensitive to capital expenditure.
And how do they look at the broader stock market equities? Also differently.
Very differently, yes. The contrarian take here is that equities, or at least certain sectors, are actually oversold precisely because of this fear-driven reaction.
Okay.
They see this environment, especially if the Middle East tensions maybe ease a bit but don't totally disappear, as presenting deep cyclical value.
Deep cyclical value. What does that mean exactly?
It means finding companies and sectors that got hit hard by the sell-off. Think airlines, consumer discretionary stocks, infrastructure that might now be trading at unusually low valuations relative to their longer-term potential.
So buying when others are fearful, essentially.
That's the classic contrarian idea. And the suggested strategy from the sources involves maybe a tactical rotation within your portfolio.
How so?
Well, it suggests potentially selling what they called hedge tickets positions, maybe in defense stocks, or other safe havens that have already rallied strongly.
Like taking profits there.
And using that cash to buy into these undervalued cyclical companies. The material noted some of these cyclicals might be trading at absurd yield spreads.
Absurd yield spreads. Sounds technical.
It does, but it basically just means the potential return you might get from holding these stocks compared to safer investments like bonds is historically wide. It suggests they might be unusually cheap relative to the perceived risk.
Interesting. Okay, what about the Fed situation we discussed? Does the contrarian view have a different angle there too?
It does. They believe the market might be sort of misinterpreting the Fed's stance, or at least oversimplifying it. Well, while markets are busy pricing in rate cuts, the contrarian take emphasizes that the Fed's #1 focus remains squarely on inflation, especially with oil prices now potentially adding to that pressure.
Right.
The idea that the Fed would just pivot to cuts only because the economy is maybe heading towards a recession. That scenario is seen as potentially ripe for mispricing by the market.
So what's the suggested play there?
One idea outlined in the sources is maybe a short volatility position, essentially betting that market swings will actually decrease from here. Or perhaps being underweight in real rates, which are interest rates adjusted for inflation.
Okay. And finally, gold, the classic safe haven. A contrarian take there too.
Yeah, a bit of one. The view presented is that while gold is, the traditional go-to asset during turmoil,
Sure.
rising real yields, that's the return on things like treasuries after you account for inflation, could actually limit gold's upside from here.
Why is that?
Because gold doesn't pay any interest or yield. So when real yields on other safe assets go up, those interest-bearing alternatives become relatively more attractive compared to holding gold.
Makes sense. So what's the contrarian bet? Sell gold.
Not necessarily sell all of it, but one high-conviction idea suggested was to reallocate maybe half of one's gold exposure.
Okay, half out of gold into what?
Into instruments that offer actual real returns. Specifically, they mentioned floating rate corporate credit. That's debt where the interest paid adjusts with market rates, and also opportunistic emerging market debt.
So moving from pure defense in gold towards assets offering some yield and maybe growth potential elsewhere.
Exactly. It's a move towards capturing yield in what might be undervalued credit market.
Okay, so taking all these contrarian ideas and trying to translate them into potential actions. The sources offered some specific strategies to consider, right, across different assets. For oil exposure, what did they highlight?
One strategy mentioned was buying those WTI $80 plus call options, maybe with a September to December expiry. So betting on oil hitting $80 or higher later this year.
Right.
Also, maybe adding to energy exploration and production companies, E&Ps, especially ones with high operating leverage.
Meaning their profits move a lot with oil prices.
Exactly. Very sensitive.
And on the defense side, we mentioned RTX, Northrop.
Yeah, going long on companies like RTX and Northrop Grumman, seeing them as beneficiaries. And interestingly, specifically suggesting buying the dip in Raytheon, citing potential upside there.
Okay. And for those looking at those cyclical plays, the airlines, consumer stocks.
Well, one idea was selectively buying jet fuel bear swaps.
Bear swaps, betting fuel prices go down.
Right. Essentially a way to hedge or bet that jet fuel prices will fall, which would obviously benefit airlines. And maybe overweighting some emerging market cyclicals, but with the caveat that regional airspace needs to remain open.
Gotcha. And for hedging inflation beyond just, say, gold,
buying CPI-linked treasuries, TIPS, Treasury Inflation Protected Securities, their value adjusts with inflation.
Okay.
Also, potentially shorting the US dollar through non-dollar emerging market carry trades.
That sounds complex again.
It's a bit more advanced, yeah. It basically involves borrowing in a currency with low interest rates, like the dollar currently, and investing in a currency, often in emerging markets where interest rates are higher, aiming to capture that difference or carry.
Right. And finally, the sources really hammered home keeping a close eye on specific data points, didn't they? Especially ahead of key Fed meetings like the one mentioned around June 18th.
Absolutely. Watching for signals that could actually shift the Fed's perspective or tilt.
What should we, or you, the listener, be watching most closely then, according to the material?
They specifically highlighted PCE inflation data. That's the Fed's preferred measure. Keep a very close eye on that.
Okay.
Also, the ongoing trajectory of oil prices, obviously. Where does that settle? Does it keep rising?
Makes sense.
And those weekly jobless claims figures we talked about earlier, continuing to monitor those for signs of further softening or stabilization in the labor market, These are key indicators that could signal a change in the Fed's thinking.
So putting it all together, the bottom line from these sources really isn't just, oh, there was a geopolitical scare that caused a brief market dip. It's framed as potentially something bigger.
Yeah, they described it as potentially a macro pivot moment.
A macro pivot moment. That sounds significant.
It suggests the core idea is that this combination, the heightened Middle East risk feeding into oil prices, has the potential to significantly extend these inflationary pressures.
Right.
And if that happens, it could force a real shift in the Fed's expected timeline for any rate cuts, pushing them further out.
But, and this is the crucial but from the contrarian side, amidst all that big picture uncertainty and the fear-driven dips we've seen,
Exactly.
the sources strongly suggest that these very movements might actually be opening up some rare entry points, opportunities in certain equities or other assets.
Right. The contrarian stance highlighted is really about finding a kind of balance through all this volatility. It might mean holding positions that benefit from the current environment, maybe energy, maybe defense.
Hedging the immediate risks.
Exactly. While also selectively adding exposure in areas like equities and credit corporate bonds, emerging market debt perhaps, that might be trading at attractive valuations precisely because of the widespread fear.
So it's a way to position for different possibilities.
Yeah, trying to position for potential upside surprises, whether those come from geopolitics cooling down or maybe a policy shift, while also being prepared for further policy recalibration if inflation stays sticky.
So a final thought then, perhaps for you listening. As many people might be reacting purely out of fear right now, what opportunities could this volatility present if you actually look beyond the immediate headlines, if you consider these different, maybe contrarian perspectives? How does that shift your thinking about the current market chaos?